A single hospital visit can destroy years of financial stability in just days. One accident, sudden surgery, or unexpected diagnosis can leave families drowning in medical bills, debt, and stress they never saw coming. Many people believe it won't happen to them until they're forced to choose between their health and their savings. This is the harsh reality of modern healthcare. One medical emergency can turn a normal life into a financial nightmare overnight. Today, we will talk about why one medical emergency can ruin your finances. So before we start, make sure to hit the like button and subscribe to my channel. 1. The hidden financial disaster nobody expects. Most people believe financial ruin happens slowly through bad investments, unemployment, or poor money management. But for millions of families around the world, financial collapse begins with a single phone call from a hospital. One sudden heart attack, one car accident, one cancer diagnosis, or one emergency surgery can instantly destroy years of savings and stability. Medical emergencies are dangerous, not only because they threaten physical health, but because they attack every part of a person's financial life at the same time. Imagine a 38-year-old father named Daniel, who earns $4,500 per month and has saved $12,000 over 7 years. One night, his wife suffers a brain hemorrhage and requires emergency surgery costing $85,000. Insurance only covers 60% of the expenses, leaving the family responsible for over $34,000. Within 3 months, Daniel empties his savings account, maxes out 3 credit cards, borrows money from relatives, and falls behind on rent payments. The emergency lasted only hours, but the financial consequences lasted years. This is how quickly medical crises destroy ordinary families. Most households are financially unprepared because they underestimate how expensive healthcare has become. Ambulance rides, intensive care units, specialist consultations, medications, laboratory tests, scans, rehabilitation therapy, and follow-up visits create bills that pile up faster than income can replace them. One emergency can become a lifetime debt trap. 2. Healthcare costs are rising faster than incomes. One major reason medical emergencies ruin finances is because healthcare costs rise faster than salaries almost everywhere in the world. Over the past 20 years, wages for middle-class workers have grown slowly, but hospital expenses, insurance premiums, prescription medications, and surgical treatments have exploded in price. A single night in an intensive care unit can cost thousands of dollars. Cancer treatment can exceed hundreds of thousands over several years. Even minor surgeries can financially destabilize families living paycheck to paycheck. Consider Sarah, a 29-year-old teacher earning $52,000 annually. After developing severe appendicitis, she undergoes emergency surgery and spends 4 days in the hospital. The total bill reaches $41,700, including imaging tests, surgeon fees, anesthesia, medications, and recovery care. Her insurance deductible alone is $6,500. Because she misses work for 6 weeks, she also loses income during recovery. By the time she returns to work, her emergency savings are gone, and she has accumulated debt with 18% interest rates. This is the financial pressure many people face today. Even insured individuals often discover hidden costs that insurance refuses to pay. Many health insurance plans contain deductibles, co-payments, exclusions, limited provider networks, and caps on coverage. People assume insurance guarantees safety, but in reality, many families remain only one emergency away from financial devastation. 3. Lost income makes the situation worse. Medical emergencies do not only create hospital bills, they often destroy income at the exact moment expenses skyrocket. This creates a double financial attack. If someone becomes seriously ill or injured, they may be unable to work for weeks, months, or even permanently. Families suddenly lose salaries while simultaneously facing massive healthcare costs. For hourly workers, freelancers, self-employed individuals, or small business owners, the damage can become catastrophic almost immediately. Imagine Carlos, a construction worker earning $900 per week. After falling from scaffolding and breaking his spine, he cannot work for 8 months. During that time, his family still needs food, rent, electricity, transportation, school fees, and loan payments. Without sufficient disability insurance, his household income collapses by nearly 80%. Meanwhile, rehabilitation costs exceed $3,000 monthly. His wife begins working 2 jobs, but the stress damages their mental health and relationships. Eventually, they fall behind on mortgage payments and lose their home. This story reflects a painful reality. One injury can eliminate both physical ability and financial security simultaneously. Many people underestimate how dependent their finances are on continuous income. Without emergency funds or disability coverage, medical emergencies quickly evolve into housing crises, debt spirals, and long-term poverty. 4. Debt becomes the only survival option. When savings disappear, most families turn to debt to survive medical emergencies. Credit cards, personal loans, payday lenders, borrowed money from relatives, and refinancing homes become temporary lifelines. However, these financial solutions often create even bigger long-term problems. High-interest debt grows rapidly, especially when families are already struggling with reduced income and ongoing medical treatment. Take the example of Marcus and Elena, a couple with 2 children. After their son is diagnosed with leukemia, they spend nearly $120,000 on treatments not fully covered by insurance. They borrow against retirement accounts, use 5 credit cards, and take out personal loans totaling $68,000. Initially, they believe the debt is temporary and manageable. But after years of minimum payments and interest accumulation, their debt grows to over $103,000. They delay retirement, sacrifice their children's college savings, and live under constant stress for more than a decade. Debt changes people psychologically as well as financially. Anxiety increases, marriages become strained, sleep problems worsen, and mental health deteriorates. Financial pressure often continues long after physical recovery ends. Many families survive the illness itself, but spend years recovering from the financial consequences. 5. Medical bankruptcy is more common than people realize. One of the harshest realities of modern healthcare systems is that medical debt contributes heavily to bankruptcies worldwide. Many financially responsible individuals who budget carefully and avoid unnecessary spending still end up bankrupt after serious medical events. This proves that medical emergencies can overpower even disciplined financial habits. Bankruptcy often begins quietly. Families first skip vacations, then stop saving money, then miss utility payments, then fall behind on mortgages or car loans. Eventually, collectors begin calling daily. Credit scores collapse. Assets are sold. Retirement accounts are drained. What started as a health crisis transforms into total financial collapse. Consider Jennifer, a single mother who developed aggressive breast cancer at age 44. She had health insurance, a stable office job, and $18,000 in savings. But after chemotherapy, surgeries, medications, travel expenses, childcare costs, and unpaid leave from work, her financial resources disappeared within 18 months. Collection agencies pursued unpaid hospital bills totaling $76,000. Eventually, she filed for bankruptcy to stop wage garnishments and foreclosure proceedings. Stories like Jennifer's are increasingly common. The emotional impact can be devastating because many people feel shame, guilt, or failure even though the crisis was beyond their control. A medical emergency does not care whether someone is financially careful or reckless. It can affect anyone without warning. If you liked this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.